I've seen a lot of traders in my life, bright-eyed, sharp with their charts, confident in their analysis, and yet they end up losing money. They scratch their heads and wonder, how can I be right about the market direction, but wrong in my results? That's the riddle every trader faces sooner or later. And that's exactly what I want to talk about today, why you keep losing even when your analysis is perfect. Now, if you watched the previous video on blowing accounts to consistent profits, you'll remember I said trading isn't about predicting prices. It's about surviving your own habits. And this topic, it's just the next step in that same lesson. Because most traders don't lose for lack of skill. They lose because they don't understand themselves. Let's start with a truth most folks don't want to admit. The market doesn't care about your analysis. It doesn't care about your trend lines, your Fibonacci levels, or that perfect candle setup. The market is a living thing. It breathes, it shakes, it fakes, and it tests the nerves of every man who dares to touch it. You can be absolutely right about direction and still lose money if your timing, your size, or your nerve is off. Tell me, has that ever happened to you? You get the move right, but you're out too early, or too late. That's the cruel trick of this business. You can be right and still go broke. You can be wrong and still make money, because it's not analysis that pays you. It's execution. It's discipline. It's patience. You see, every trade is a test of character, not just skill. I remember once, years ago, I studied a stock for weeks. Everything lined up. The tape was clean, the volume told the story, and the setup couldn't be better. I bought it. Then it dipped. Nothing wrong with the setup, just a shakeout. But I couldn't stand watching red on my screen. I closed it for a small loss. The next morning, the stock exploded. My analysis was perfect, but I wasn't. The problem wasn't the market. The problem was me. And that's what most traders miss. They think losing means they analyzed wrong. No. Losing often means you executed wrong. You either sized too big, panicked too soon, or held too long. The market showed you what it was doing, but you didn't have the discipline to let it play out. You didn't trust your plan once the emotions kicked in. You ever notice that? You trust your chart until your money's on the line. Then the chart doesn't matter anymore. It's your fear that runs the show. Now, this ties back to what we talked about in that last video on blowing accounts to consistent profits. Back then, I said you don't build consistency by learning more indicators. You build it by mastering yourself. Well, the same thing applies here. You can have the best analysis on Wall Street, but if your emotions are the ones pulling the trigger, you'll always find a way to lose. Most traders treat the market like a puzzle they can solve with logic. But trading isn't a math problem. It's a battle between conviction and doubt. You can have all the logic in the world, but if your conviction collapses when price wiggles against you, your analysis might as well be scribbles on a napkin. Tell me something. When your trade goes against you, do you start doubting everything you thought you knew? You see the same setup you studied last week, but now, because your position is live, it suddenly looks different. That's the mind playing tricks on you, and it will keep doing that until you learn that trading is less about being right and more about staying right long enough to get paid for it. Every trader wants to be the hero who nails the top and bottom. They want to say, I called it. But calling it means nothing if you can't hold it. The big money, the kind that changes your life, comes from sitting, not from trading every wiggle. I made my fortune not by being right often, but by being right and sitting tight. Most people can't sit tight. They get antsy, they tinker, they trade their way out of profit. And why? Because they don't understand the nature of the market, or themselves. The market is designed to fool the majority. It moves in such a way that it tests every weak hand before showing its true direction. And if you don't know how to handle that, you'll end up selling your winning trades early and holding your losers too long. You ever cut a winner short just to lock in profits, only to watch it double right after? That's fear disguised as wisdom. You see, analysis is about logic, but trading is about temperament. You can train your eyes to see patterns, but you have to train your mind to wait. Every big move I ever caught, I caught because I waited. The chart told me what was coming, but my patience let it happen. Most traders have the first skill, but not the second. And here's the twist. Sometimes your analysis is right, but the market just isn't ready. You've read it correctly, but you're too early. That's another way traders lose. Being early in the market feels like being wrong, even when you're right. And that's why I say timing is the trickiest part of all. The market rewards those who can wait for confirmation, not those who rush to be the first in. So when you lose, don't rush to blame your analysis. Ask instead, did I follow my own rules? Did I control my size? Did I give the trade time to breathe? Did I trade the setup, or did I trade my emotions? Because the truth is, perfect analysis is worthless without perfect discipline. Now, you might think discipline is just about sticking to stops and targets. But it's more than that. It's about mindset. It's about having the emotional capital to act rationally when the market tries to shake you out. You can rebuild financial capital, but emotional capital, once that's drained, every tick feels like a personal attack. And that's when traders make the worst decisions. You want to build wealth in this business, then learn to stop reacting to every flicker on the tape. The tape is noise until it confirms your thesis. Until then, your job is to wait, watch, and protect your capital. Because capital is your ammunition, and patience is your edge. Think of the market like the ocean. You can't control the waves, but you can learn when to swim. The analysis tells you where the tide might turn, but your discipline decides whether you drown or ride the wave. And that's why so many good analysts end up broke. They keep jumping in before the tide shifts. So remember this, the market doesn't pay you for being right. It pays you for being aligned. Aligned with the trend, aligned with your plan, aligned with your own temperament. And that alignment only comes when you stop trying to force the market to match your analysis and start letting it confirm your bias instead. Because in the end, it's not the chart that beats you. It's yourself. And until you understand that, no amount of perfect analysis will ever make you a winning trader. Perfect analysis is useless without disciplined execution. That's a truth most traders learn the hard way, usually after losing money on trades they were right about. You can study charts for hours, identify the cleanest setup, mark every level with precision, and still end up losing. Why? Because analysis is only half the battle. The other half, the half that actually decides your success, is discipline. Discipline is what bridges the gap between knowing what to do and actually doing it. You can tell yourself you'll wait for confirmation before entering, but when the candle starts moving fast, temptation whispers, "Get in now." You can set a stop loss, but when price approaches it, fear convinces you to move it just a little lower. You can plan to take profits at a certain level, but greed tells you to hold for more. Every time you listen to that voice, your discipline weakens, and your perfect analysis becomes worthless. Let me ask you something. How many times have you looked back on a losing trade and realized your original plan was right? That if you'd just done what you said you would, you'd have made money? That's not bad luck. That's a lack of discipline. The market didn't betray you. You betrayed your own rules. And in this game, that's the most expensive betrayal there is. I've seen traders who can read charts like poetry. They understand structure, they read volume, they know every technical pattern in the book. But the moment money is on the line, all that knowledge evaporates. Their hands shake, their mind races. They abandon the system they spent months building. Because analysis lives in the mind, but discipline lives in the gut. The chart doesn't test your skill, it tests your nerve. The thing about execution is that it requires you to act without hesitation. Once your plan is set, you follow it. No second guessing. No, maybe it'll bounce. Discipline means accepting that sometimes you'll be wrong and still following your rules. That's what most traders can't stand. The idea of losing while doing the right thing. But that's exactly how you build consistency. You see, trading discipline isn't just about self-control. It's about trust. Trust in your system, trust in your process, trust that long-term probability will reward you if you stay consistent. Most traders don't have that kind of trust. They're still chasing certainty. They want every trade to work out, and when one doesn't, they tweak their rules, change indicators, or abandon their plan entirely. That's not trading. That's gambling dressed in analysis. Now, remember in the previous video on blowing accounts to consistent profits, I said you can't build consistency without emotional maturity. This is where that lesson ties in. Perfect analysis means nothing if your emotions still run your trades. You can have the most accurate forecast in the room, but if you size up too big, hesitate to cut a loss, or let greed stretch your hold time, the market will take your capital and teach you humility. The disciplined trader knows that execution is a skill of repetition. It's not glamorous. It's not about adrenaline or big wins. It's about showing up every day and executing the same rules the same way, even when you're bored, even when you're frustrated, even when your last 3 trades were losers. That's what separates the professional from the amateur. Ask yourself, how many of your losses came from bad analysis, and how many came from breaking your own rules? Be honest. If you're like most traders, the answer is obvious. You didn't lose because the market fooled you. You lost because you didn't follow through. You entered too early, or too late, or you refused to accept a small loss and let it turn into a big one. The lack of discipline, not the lack of knowledge, is what keeps most traders stuck. Discipline is the only thing in trading you can truly control. You can't control the market. You can't control volatility. You can't control what the institutions do. But you can control when you enter, when you exit, and how much you risk. And yet that's exactly what traders surrender first. They give control of their actions to their emotions. They trade from impulse instead of intention. They say they trust their plan, but when it's time to act, they flinch. It's easy to have discipline when the trade goes your way. The real test comes when it doesn't. Can you stay calm while your stop gets hit? Can you accept the loss without revenge, trading the next setup? Can you sit on your hands when the market isn't offering a clear edge? That's discipline, and that's what most traders never master. Some traders think discipline is about restriction, like it's a punishment. It's not. Discipline is freedom. It frees you from confusion, from overthinking, from emotional chaos. When you have clear rules and the strength to follow them, the market can't rattle you. You stop chasing every move and start waiting for your move. You stop reacting to noise and start acting on signals. Every great trader I've ever known, including myself, made the real money not by predicting markets, but by following process. I could read a stock perfectly, but without disciplined execution, I'd still lose. The moment I started obeying my own rules, without hesitation, without debate, everything changed. Not overnight, but gradually, my results stopped depending on luck and started depending on my behavior. Perfect analysis gives you the map. But discipline is what keeps you on the road. Without it, you'll keep taking wrong turns no matter how detailed your map is. The market rewards those who act consistently, not those who analyze perfectly. You can study patterns all you want, but until you learn to execute your edge without emotional interference, you'll stay in the same loop right on paper, wrong in profit. And here's the thing most traders won't admit. Discipline is boring. It's not exciting to follow rules. It's not thrilling to take small losses or wait for days without a setup. But that's exactly what successful trading looks like. If your trading feels exciting all the time, you're probably doing it wrong. The pros find excitement in precision, not in chaos. The truth is, a disciplined trader with average analysis will outperform a brilliant analyst with no control every single time. Because markets don't pay for intelligence. They pay for execution. You can't deposit being right into your account. Only disciplined trades pay. Only disciplined trades survive the long run. So next time you take a trade, don't just ask, is my analysis correct? Ask instead, will I have the discipline to follow through when it matters? Because that's where the real edge is hidden. Not in the setup, not in the strategy, but in the execution that never wavers, even when the market tries to make you doubt everything you know. Being right too early in the market still counts as being wrong. That's one of the hardest lessons any trader has to swallow. You can spot the perfect setup, see the trend before anyone else, call the direction with surgical precision, and still lose money. The market doesn't reward early guesses, it rewards synchronization. You can't just be right, you have to be right at the right time. Most traders confuse insight with timing. They think seeing the move before it happens means they've got an edge. But the market doesn't care what you see. It only pays when you align with its rhythm. You can know exactly where price is headed, but if you enter before the market's ready, you'll get shaken out, stopped out, and then watch it run without you. You ever had that happen? You get in too early, price dips, you take a loss, and then your analysis plays out perfectly, just without you in it. That's not bad luck, that's bad timing. The market isn't a machine that follows your logic. It's a living organism that moves when it wants to, not when you do. Being early is still being wrong, because trading isn't about prediction. It's about participation. You can predict the rain, but if you plant your seeds before the season, they still won't grow. Timing is what separates the analyst from the trader. I've been there myself. Back in my early days, I'd spend hours studying the tape, feeling the pulse of the market. I'd see accumulation forming, volume increasing, and price coiling up tight. I'd buy in, certain I was early to the move. Then the stock would sag, not because I was wrong, because I was too soon. The big move came days later, but by then I was out, licking my wounds, watching the same setup play out perfectly without me. That taught me something. Being early in the market isn't foresight. It's a form of impatience disguised as confidence. And that impatience costs more than any bad trade. Because when you're early, you're fighting the market's natural rhythm. You're trying to force it to move before it's ready. That's like pushing a river to flow faster. The market doesn't respond to force. It responds to pressure, to weight, to timing. You can't control that. All you can do is wait for confirmation that the move has actually begun. Ask yourself, why do you rush in early? Is it because you're afraid of missing the move? That fear of missing out is the silent killer of traders. It makes you jump the gun, thinking you're being smart when, really, you're just being impatient. You don't need to catch the exact bottom or the first tick of a breakout to make money. You need to be in when the market confirms your thesis, not before. And that's what ties back to the lesson we talked about in the last video on blowing accounts to consistent profits. Remember how we said that most traders blow up not because they can't read charts, but because they can't wait. This is the same principle. Patience and timing are two sides of the same coin. You can't be consistent without mastering both. A lot of traders like to say, I called it. They brag about predicting the move, but calling it means nothing if you didn't make money on it. The market doesn't pay for accuracy, it pays for timing. You can be right about direction 6 months too soon and still go broke. The market pays you when your position and its movement align, not when your ego says, I told you so. Being early also drains emotional capital. You take a few premature entries, get stopped out, and suddenly you're hesitant to re-enter when the real move begins. Your confidence fades just when you need it most. Then you watch from the sidelines as the market finally does what you expected all along. It's a brutal cycle. Early, stopped out, discouraged, and then too afraid to act when the timing is finally right. That's how traders miss the money even when they see the opportunity. You have to remember, the market doesn't move in straight lines. It moves in phases: accumulation, markup, distribution, markdown. Each phase has its own pace, and your job is to identify not just what phase you're in, but when that phase is about to transition. Getting in during accumulation, before demand fully outweighs supply, means you'll sit through endless chop. You might be technically right, but you're early enough that your capital gets tied up or eaten by volatility. A professional waits for confirmation. They wait for the tape to prove that the move has started. Timing also applies to scaling in and scaling out. If you're too early with your full position, you've left no room to adjust. The disciplined trader scales in as the market confirms. He doesn't throw all his weight in before the turn. He builds into strength. That's not caution, that's wisdom. The amateurs call it hesitation. The professionals call it survival. Have you ever noticed that the best trades often feel uncomfortable when you finally enter? That's because by the time confirmation arrives, the move has already begun. It doesn't feel safe anymore, but that discomfort is a sign that the timing is right. The crowd starts to recognize what you saw earlier, and now momentum's on your side. Early entries feel safe because no one else sees the move yet. But safe entries rarely pay. The trick is to stop trying to be first and start trying to be aligned. You don't need to outsmart the market. You need to synchronize with it. Every big move leaves footprints before it happens. Volume swells, volatility compresses, and momentum builds. But those signs don't mean it's time to act. They mean it's time to prepare. The entry comes when the market confirms, not when you feel clever. Think of it like catching a train. You can arrive early and wait, but if you step onto the tracks before it comes, you'll get run over. The train has a schedule. The market does too. It just doesn't post it for you. You learn to read it through patience, observation, and experience. Being early isn't insight, it's ego. It's that quiet desire to be the first one to see it, the first one to act, the one who called it. But this game doesn't reward pioneers. It rewards professionals who wait until the move proves itself. The best traders aren't the first in. They're the ones still in when everyone else has been shaken out. So when you analyze a chart and think you see the next big move forming, stop and ask yourself, am I early or is the market actually ready? Are buyers stepping in? Is the volume confirming? Has price broken structure with conviction? Or am I just impatient to be right? Because until the market agrees with your analysis, your opinion is just that, an opinion. And opinions don't make money. Timing does. Timing and position size turn analysis into profit. You can be the sharpest analyst in the room, reading every candle and predicting every turn. But if your timing is off or your position size is wrong, your profits will vanish as quickly as they appear. The truth is, analysis is the foundation, but timing and sizing are the tools that actually build the house. Without them, even the best ideas collapse. Most traders spend all their time trying to perfect their analysis. They think if they can just find the right indicator, the right setup, the right secret formula, they'll finally be consistent. But that's a trap. Analysis alone doesn't make you money. Execution does. And execution is made of two moving parts, when you enter and how much you commit. Get those wrong, and even the best setup will turn against you. Timing is everything in this business. You can be right about the direction, right about the structure, and still lose if you're too early or too late. You ever notice that? You take a trade, it goes a few ticks against you, you stop out, and then it reverses in your favor right after you're gone. That's not the market mocking you. It's your timing testing you. The market always rewards patience, but it punishes anticipation. The difference between the two is subtle, but it's everything. Ask yourself, do you trade because the setup is ready, or because you're tired of waiting? A lot of traders convince themselves a move is about to happen just because they're bored. They see what they want to see, not what the tape is actually showing. That's how timing slips away. You have to let the market show its hand before you act. Wait for confirmation. Wait for momentum. Wait for the story to start unfolding before you jump in to write your own ending. And when the timing is finally right, your next weapon is position sizing. That's the one most traders underestimate. You can have perfect timing and still lose because you over-leveraged or under-leveraged your position. Trade too big, and a small pullback wipes you out before the move even begins. Trade too small, and you waste a perfect opportunity. Sizing is balance. It's how you stay alive long enough for your edge to play out. Back when I was trading heavily in bucket shops, I learned fast that my biggest profits didn't come from being smarter than the market. They came from managing size like a surgeon. I used to scale into positions, not all at once but in parts. A small piece first, then add when the market confirmed. That way I wasn't gambling. I was testing. Let the market prove me right before I risked more. That's the discipline most traders never develop. They go all in before the move even breathes. Then they spend the rest of the trade praying instead of managing. Timing without control over size leads to chaos. The market doesn't care how confident you are. It only cares how much pain you can handle before you fold. That's what position sizing is. An insurance policy against your own emotions. You're not just controlling risk, you're controlling fear. Because when your size is too big, every tick feels personal. Every red candle feels like an attack. And when that happens, you stop thinking clearly. You start reacting. Now remember, in that previous video on blowing accounts to consistent profits, we talked about emotional stability and patience. This is where it comes full circle. Timing and sizing are emotional decisions disguised as technical ones. You can't time well when you're anxious. You can't size properly when you're greedy. The mind influences both, and the market always exposes whichever emotion you're hiding. A disciplined trader waits for his moment. He doesn't need to be in every move. He just needs to be in the right move. That's timing. Then, when the setup proves itself, he increases his size strategically. That's conviction. It's not about gambling more. It's about pressing when the odds are in your favor. Most traders do the opposite. They trade big when they feel confident and small when they should. Confidence isn't an edge. Data is. Let me ask you, how many times have you doubled down on a losing trade, convinced your analysis was right, only to watch the market keep going against you? That's not timing or sizing. That's ego. You're fighting price action instead of following it. The pros never fight the tape. They size smaller when they're uncertain, larger when the market confirms. They don't hope to be right. They position themselves to benefit when they are. Timing also means knowing when not to trade. There are moments when the market gives mixed signals, when the tape feels heavy, or when volatility's too thin. That's when discipline matters most. Sitting out is a position too. The trader who learns to wait for clarity always outlasts the one who trades every flicker. You can't win if you're always in. Sometimes the best trade is the one you didn't take. And when the right moment finally appears, your position size becomes your voice in the market. Small size means you're testing. Medium size means you're confident. Large size means you're convicted. The mistake most traders make is they speak too loudly when they should whisper. They think bigger size equals bigger profits, but it usually equals bigger mistakes. The pros don't trade big to feel important. They trade right to stay consistent. Timing and size also work together to protect you when you're wrong, because you will be wrong. The goal isn't to avoid losing trades. It's to survive them. When your timing is slightly off but your position is small, the damage is light. You can recover. But when both are wrong, when you're early and oversized, that's how accounts disappear. That's how confidence gets destroyed. Good timing feels patient. Good sizing feels boring. The combination of both feels almost effortless. That's when you know you're trading in rhythm with the market, not fighting it. You take your shot when the tape confirms, not when your gut itches. You scale in carefully, manage your risk, and let the trade work without interference. That's how analysis turns into profit. Not through prediction, but through precision. It's easy to obsess over entry signals, chart patterns, or news catalysts. But none of those things will make you money if your timing is off or your position is reckless. This business rewards patience and punishes haste. It rewards balance and destroys excess. The trader who learns when to act and how much to risk doesn't need to predict. He just needs to react correctly when the market presents opportunity. So next time you're staring at a perfect setup, ask yourself, is the timing right, or am I forcing it? Is my size appropriate for my conviction, or am I just chasing returns? Because every trade you take is a mirror. It reflects not just your analysis, but your self-control. And only when timing and position size work together does your analysis finally translate into the one thing that matters in trading: profit. The real battle in trading is between conviction and doubt. Every trader thinks he's fighting the market, but that's not true. The market doesn't even know you exist. The real fight happens inside your own head, between the part of you that believes in your analysis and the part that's second. Guesses every decision the moment money is on the line. Every tick tests which side is stronger. When you're studying the charts, conviction comes easy. You see the setup forming, the structure makes sense, the risk to reward looks perfect. On paper, you're calm and logical. But the moment you take the trade and your money is at risk, logic takes a back seat. Doubt creeps in. You start seeing things on the chart that weren't there before. Every small fluctuation feels like a threat. Every pullback feels like a reversal. The same setup that looked crystal clear an hour ago suddenly feels uncertain. Tell me, hasn't that happened to you? That's the war every trader faces. The battle between conviction and doubt. Conviction keeps you in the trade when it matters. Doubt pulls you out just before the move begins. Conviction lets you follow your plan. Doubt makes you abandon it. The market doesn't decide who wins that battle, you do. Conviction doesn't mean arrogance. It doesn't mean ignoring risk or pretending you're always right. True conviction comes from preparation.